under the noise, central bank sovereigns and institutions have been actively converting dollars into physical gold. Gold is the only alternative sufficiently liquid, non-dollar denominated, high-quality liquid asset that can be collateralized. Also, as reaffirmed yet again this week by Jeff Curry, and he did it last week, he's done it again this week, he says, all real assets are under accumulation into this short-term dollar aberration. And led by gold, this 30-year Goldman Sachs veteran, obviously now heading up the Carlyle Group, is buying what he calls the halo, the heavy assets low obsolescence trade. In other words, selling debasing dollars to buy all qualifying halo hard assets. Now, Curry represents everything that central banks, sovereigns, and institutionals are doing. This is one of the primary drivers that will continue to evidence the long for their own gold books bullion banks, projecting unfazed 5,600 to 7,000 2026 gold targets.
The gold price has appreciated in value by 290% in the past decade on accelerated demand for safe haven assets. Rising geopolitical conflicts and global economic disruptions are fueling demand for the precious metal. From retail and institutional investors to central banks, gold as a hedge against such uncertainty is becoming a strong pillar of support for higher gold prices. Financial expert and renowned commodity trader Andrew Maguire explains that despite short-term volatility, the medium to long-term outlook for gold and silver remains strongly bullish, driven primarily by sustained physical demand rather than paper market activity. He points out that the rally following the March price dip was fueled by real buying of physical gold, even as prices were temporarily pressured by liquidity events and dollar shortages. According to him, gold performed exactly as expected during this stress period, acting as a highly liquid asset. He emphasizes that physical markets continue to absorb any price weakness, showing strong underlying demand. From a technical view, Maguire mentions that much of the recent price suppression is driven by derivatives and thin market conditions, particularly around key events. However, physical buyers, especially in Asian markets, are taking advantage of these artificially lower prices, reinforcing a strong floor under gold and silver. He predicts that institutional flows are increasingly shifting away from the US dollar and into hard assets, with central banks and sovereign entities steadily accumulating gold. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Andrew Maguire's recent interview.
Let's start by taking a very quick look at some of the very bullish medium to long-term drivers that, under the war-induced tweet bingo, telegraph substantially higher prices for gold and silver through the remainder of 2026. So, picking up the thread from our last market update, following the March 23rd $4,100 spike bottom, driven 100% by underlying physical gold demand, this rally $700 higher price, despite the fact that we've got a similar plus or minus $100 Brent oil price as we saw here. So essentially, we've kind of pointed this out last time, but it's between $700 and $800 higher based on the same oil price. Really gives you an idea that these mechanical correlations are being taken advantage of in the physical markets. And this was a race into dollars, with gold acting as the perfect liquid asset to be able to suddenly create those dollars. And it involved, obviously, some leases and some sales of gold. Gold did what it was supposed to do, hedge positions and create dollar liquidity when it wasn't there. And you can clearly see physical gold was repurchased. And as we evidenced into yesterday's COMEX-driven dips, it was designed to get the worst possible price, and it just gets snapped up in the tight for supply, physically settled markets. Liquidity providers assess this physical market discipline has forced a combination of momentum short covering alongside leased gold being bought back at higher prices. And following this race to sell gold to meet dollar shortages, the mainstream media is under the misapprehension that gold is no longer a safe haven hedge, ignoring the fact that it provides instant first-tier liquidity into the war-driven, oil spike-driven flash dollar shortages, whereas central bank sovereigns and a very healthy suite of institutional traders widely view gold as the ultimate safe haven. We're evidencing many institutionals publicly unshaken from this view. So into this third week of heavily capped action, well, tweet bingo conditions really, the liquidity has been so thin that intraday crosses oscillate between bullish and bearish and then back to bullish again. If the paper market had full control, this would not have been the bottom. They would have been targeting significantly lower. Now, the bull-bear battle ahead of options expiry on Monday, and that is always a derivative event, it focuses on this 3-week capped 4,800 level, which is pretty much what we're looking at here. And that is, so 4,800 futures is about 4,818 it's spot 4,800 in spot is 4,818 equivalent. Now, while it's clear that silver, which goes into first notice and delivery a week today on Wednesday the 29th, it has been attracting physical bidders on every COMEX generated dip. Now, all the war-induced gold and silver futures-driven price compression has been COMEX-centric, with the momentums taking advantage of gaming thin conditions and wide spreads, the bid-ask spreads wide. None of the market makers really want to make a market in this condition. And with the bulk of the derivative sell weight following the silver and gold foreign exchange fixes, and you see most of the selling coming in after the fixes every single day. And also in silver, we're also seeing that really a lot of that action happening after the fixes, but far more so in gold. Net of that, last Friday's 48.70.50 PM fix marked the highest fix in a month. Yes, it's been gained lower, but synthetically. Into continued thin market momentum-centric capping, into commercials exposed to T+1 delivery obligations, taking the long side, the gold fixes have, through this period of bullish consolidation, have typically evidencing a cycle of commercial buying and momentums then being forced to short cover. This synthetic capping action, which has followed each fix, is not going unnoticed in SGE-related Asian physical markets, capitalizing on this synthetically underpriced gold and silver. From a medium-term perspective, notwithstanding the bullish for gold and silver lurking private credit crisis and the CDS risks that are associated, the dollar looks ripe for a significant decline against gold and silver alongside all hard assets. There is no damage done. This race into gold, silver and hard assets became pretty clear following the initial spike race into dollars to meet oil-related supply shortages, during which it is the view of every single liquidity provider that the debt-laden dollar was going to resume its structural long-term decline. No damage has been done, despite the best efforts of the COMEX insiders. So as you can see, the UAE threat to significantly set up selling oil in Chinese yuan poses the most serious challenge to confront the petrodollar system since the creation of that slippery slope. And this comes off the back of Bloomberg reporting custodial dollar reserves are at 2012 lows and rapidly declining. I think we showed that link last time. Look, under the noise, central bank sovereigns and institutions have been actively converting dollars into physical gold. Gold is the only alternative sufficiently liquid, non-dollar denominated, high-quality liquid asset that can be collateralized. Also, as reaffirmed yet again this week by Jeff Curry, and he did it last week, he's done it again this week, he says, all real assets are under accumulation into this short-term dollar aberration. And led by gold, this 30-year Goldman Sachs veteran, obviously now heading up the Carlyle Group, is buying what he calls the halo, the heavy assets low obsolescence trade. In other words, selling debasing dollars to buy all qualifying halo hard assets. Now, curry represents everything that central banks, sovereigns, and institutionals are doing. This is one of the primary drivers that will continue to evidence the long for their own gold books bullion banks projecting unfazed 5,600 to 7,000 2026 gold targets. That's where they that's where they see gold this year. And this largely unnoticed race into monetary gold has accelerated to take advantage of an overpriced dollar versus inversely underpriced gold, while a small percentage of these conversions have been officially captured and only a tiny percentage, such as the 5 tons of Chinese demand stepped up in March, and there's 1 or 2 other reports of a few tons here and there. But the largest percentage, and we're talking literally hundreds of tons of monetary gold accumulations, stay off the radar. The small percentage of central bank gold sales to plug immediate dollar shortfalls largely consisted of, because we talked about, people were saying, oh, yeah, but they've been selling their gold. No, it largely consisted of leased or swap gold, the bulk of which still has to be bought back at a market price.
During the interview, Andrew Maguire explains that the influence of the COMEX paper market is gradually weakening as investors exit leveraged positions and shift toward physical gold and silver. He notes that falling open interest signals a transfer of metal into stronger hands, while repeated flash sell-offs in thin trading conditions continue to distort prices. However, these dips are quickly absorbed by physical buyers, especially in Asia, showing that real demand remains firm beneath the surface. Recent developments reinforce this trend, as reports highlight strong physical premiums in Shanghai and continued large-scale withdrawals from COMEX inventories. At the same time, central banks, particularly in China, are increasing gold accumulation, while global institutions are raising long-term price targets for gold and silver. Together, these signals point to a growing disconnect between paper pricing and physical market strength, suggesting that physical demand is increasingly driving the market's direction. Let's jump into the interview.
I've fielded so many questions on the longevity of this COMEX paper market influence on the price setting process, naturally. So to answer these relevant questions and to draw from the COMEX's own published data, we're going to see that under this extreme volatility, which undoubtedly favors the cash settled markets, we are witnessing the final stages of really the gold and silver markets irreversibly moving from weak hands into strong physical hands. Now, to address this, I'm going to start this week's episode by looking at the latest COMEX generated COT reports. Now, as you can probably see here, not because they reveal any useful microdata, but because when connected the dots from the open interest highs of 800,000 contracts in 2020 into a cliff fall exit of this open interest into current 367,000 contract levels, that's a one-way exit of 1,400 tons of physical and 100% one leverage gold, which actually really is more like 140,000 tons of dilutive paper leverage. That's never going to return. Now, in silver, we see an exit of 18,500 tons, which, as CPM stated some while ago, they said, yeah, 500 to 1 for silver, so what? Well, at 500 to 1, that actually evidences an exit of 9.3 thousand tons. Yes, that number, 3,000 tons of dilutive open interest, seeking actually a safe haven refuge. People are won out of this mayhem, which is, we're going to see really how it's generated. Now, these smoke and mirrors COT reports do provide us a window into the degree that the LBMA CME price settling benchmarks are becoming irrelevant. And with the LBMA dependent on being able to cash settle foreign exchange gold and silver into its collusive COMEX partnership, we're witnessing the LBMA's last gasp as a global price-setting hub. So let's dig in. Long-term subscribers will know why we mistrust this deliberately delayed official weekly reported COT data. We're going to look at it in a second. And why we cannot take it at face value. Therefore, in order to make sense of these reports, it requires us to, as best as possible, weigh in the one-sided COMEX data against the deliberately unreported offsetting LBMA over-the-counter data. Now, given both sides of these transactions are held by the same commercial market makers, but the invisible reported offsetting over-the-counter leg of the report that's published is just accepted at face value by the self-regulated CME. This can and has historically proved to enable some very bad actors to directionally employ an otherwise illegal hidden position concentration level and for it to exist. Now, if a single entity or a potential cabal of traders with a common goal own a large enough percentage concentration of issued leveraged COMEX open interest, the chips in the casino, and of course these are all cash-settled futures positions, then they ultimately control the direction of that asset's price. And this was a major concern that Commissioner Bart Chilton, he is CFTC Commissioner, publicly drew attention to during his tenure at the CFTC, specifically drawing attention to such concentration being utilized to directionally manipulate silver lower after JP Morgan took over the untenable Bear Stearns short silver position in 2008. And it was actually the Bear Stearns silver position that imploded that bank. All of this data is extremely well documented. Now, I'm recording this episode on Wednesday for release tomorrow. And you can see we're trying to get these things out as quick as possible. And as a recent example, let's look at yesterday's COMEX-driven footprints. Now, drilling down into yesterday's full session, end of ceasefire bearish skew, all session long, it had been bearish right from the opening through the AM and then the PM fix. Right on cue, we evidenced a perfect example of a bad actor employing a directional position concentration ahead of the COT cutoff, which was down here. Undoubtedly, this was officially sanctioned as it was just too obvious. But let's just pick up this one bar here. Basically, this is what we're picking up on. To illustrate that the tweet-driven action is 100% COMEX-driven, the timing of 23,000 contracts, 106 tons of gold futures open interest was flash dumped directly after the fix, and clearly designed to get the worst price. And essentially what they were doing was chart painting a bearish skew, and undoubtedly related to Friday's yet to be published COT cutoff, which won't be published until Friday. And then we'll see what the action entailed. But this flash discount did not go unnoticed. This is ludicrous to see this kind of volume of being actually sold into in a flash sale to get the worst price. In the most illiquid, waiting till the fix was done and it was illiquid. As I say, it didn't go unnoticed, simultaneously evidencing very strong Shanghai spot gold physical premiums into this sell-off. And looking at the 4-hour charts, we can better see in a less granular form the commercials exposed to upcoming T+1 physical market delivery obligations. We're hedging this exposure into the 4683.20, the 382 FIBO. This is the retracement fiber. Everyone looks at this. Now, undoubtedly taking the long side of a rapidly dwindling number of freshly sucked in momentum shorts, which is exactly what happened as soon as we see a sell-off. And par for the course, what do you see happening again today? Wait for the PM fix and then literally start selling into illiquid conditions. Now, clearly, this is paper versus physical, and the physical market is simply taking it. Similarly, silver evidenced a concurrent flash sold, literally here, 1,000 tons of paper market, literally 1,000 tons, also seeking to chart paint the commercial cutoff, which they did by the time it got down to here. And then, of course, the momentums continued to try and sell it. So essentially, it was designed to draw in these sellers, which will provide the commercials fuel to short cover into.
Gold prices are projected to continue rising in 2026, with forecasts suggesting a potential climb towards $7,000 per ounce by year-end, driven by intense central bank buying, geopolitical tensions, and de-dollarization trends. Despite short-term volatility and recent pullbacks, analysts maintain a bullish long-term outlook, viewing consolidation as a pause rather than a trend reversal. Silver, with its tightening supply and rising industrial demand, may outperform gold in percentage terms, potentially entering a phase of rapid price expansion. At the same time, continued de-dollarization efforts and increased use of gold in global settlement systems could further strengthen its monetary role. If physical demand continues to dominate and central banks keep accumulating, could we be approaching a point where paper markets lose control entirely? And how high could gold and silver go when true price discovery finally takes hold? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.